You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, we are in the heart of earnings season. So the big stocks, all the FANGs are announcing around this time period. And probably the biggest one is announcing today after the close, Amazon. And we always like to look at some strategies based off of Amazon. The one thing that's always fun about the two biggest FANGs, Amazon and Google, is their price point. They basically are valuations equal to the indexes. Amazon right now is currently trading at $1,701. It's up $31 on the day. And I should also let you know that we are taping Options Playbook Radio on Thursday, the 31st. The market is open, so we are moving along here. And if I look at Amazon, the trade that we have talked about as a paper trade more often than not on the bigger price stocks, because you can go so far out of the money and you can go a decent width between the strikes, is the skip strike butterfly. So that's what we're going to look at again. If things make sense, why not just keep doing them? So this paper trade for this week, and once again, it's not meant to be a recommendation. And as always with Options Playbook Radio, we're just trying to learn about the timing of strategies and when they might fit in to the current market conditions. And in this instance, we have Amazon trading, and we're going to call it 1,700. We're going to make the math simple. The market is moving as we speak. And when we're doing skip strikes, we want to be as short of term expiration as possible. And the thing that's nice about Amazon is that they announce tonight after the close, and then you have 1 day of trading, which is Friday. And at the end of Friday, the options got to go away. So you have this huge pump up in implied volatility going into a weekend, and all that volatility and any time premium that's in it has to go away. So the time premium is created by volatility, and it's also created by the fact that it's a $1,700 stock, and all that makes it a very interesting underlying to execute advanced option trades in, to just be blunt about it. So in this instance, how do we always start when we're looking at a trade around earnings? Well, we want to know approximately what the expected move is. And how do we find that? We look at the most at-the-money strike. In this instance, it's the 1,700 strike. We look at that, and we just add what the buying the long call and buying the long put would be, which is called a long straddle. And right now, we currently have that trading at about $97 is where it's at. So the expected move on Amazon is almost 100 points. And that's kind of what we're going to go with. So 97 divided by 1,700 is that's only about a 6% move. So that's not amazing. It's a large number, mainly because the stock is a $1,700 stock. So looking at about a 6% move, that's the expected move after earnings. And once again, that's just the line in the sand. Whenever you look at the long straddle, it's what the marketplace says this could potentially happen. And if the line, if it's under that, that means, well, you wanted to take the under. If it's over that, you wanted to take the over. But bottom line is that's what the marketplace looks at, and it gives you a realistic expectation going into earnings as to, what could this underlying stock actually do. So with that mentioned, we're going to go out 100 points. We need to go out at least 100 points on this trade just to try to protect ourselves. We'd like to get out almost as far as possible because we're going to try to get the trade done for a net credit. So if we start at 1,700 and I go all the way down to the 1,800 strike, I think I'm even going to tweak it up a little bit. Let's start at the 1,805 strike, $1,805 strike on the one-day option contract. That's going to be the one that we buy. Now, we're going to go 15 points wide, and the biggest thing about the width between the strikes is understanding that if I'm doing this in a skip strike butterfly, the more width that I have, the higher the requirement is going to be, the margin requirement to do the trade. I wouldn't mind going 20 points wide, which would give you 20 points of upside, but then I got to put down more money on the back end because I'm gonna skip a strike and I'm gonna have a 20-point wide short spread that's actually paying for my long spread. And that's the way that I always like to look at butterflies. You're looking at, you're selling a spread to help pay for another spread is really what happens with a butterfly overall, because it's really just a combination of one long spread and one short spread. Okay, so with that said, we're going to go 15 points out. 1,805 is going to be the strike that we buy. We're going to sell the 1,820, and we'll be selling 2 contracts of that. Then we're going to go and skip the 1,835 strike. That's the one that we normally buy to make this a quote-unquote normal butterfly done for a net debit. And when we skip that, that's trading for $5. We're going to go down to the 1,850 strike. So we skip it, and basically that's embedding this little short credit spread from 1,835 to 1,850. And whatever credit we receive on that is going to help pay for the butterfly. So we skip that, get all the way down, and then we have a 1 by 2 by 1, the 1,805 strike, 1,820 strike, 1,850 strike. We're going to do that with 1 day remaining to expiration. And right now, the midpoint is trading at 83 cents. It's a fairly wide bid-ask spread because the stock is really volatile. The natural is a 15-cent credit to the account, and the ask price, or the best case scenario, is $1.40. So in this instance, we're going to trade somewhere near the midpoint. Well, let's call it 80 cents, just because it's bouncing around right there. As I said, the market is open right now. So it's going between 75, 80, 85. We're going to call it 80. That's the number I've seen the most. So we're going to do this thing for an 80-cent net credit to the account. Now, that is our upside if we are dead wrong on the trade. So if the market opens flat or down or up just a little bit, well, all the options would expire worthless in concept. They only have 1 day to live. And if that happens, I can make that credit of 80 cents in my account. If all the options go away, expire worthless, I'm going to make 80 cents. But the downside is I have risk. But my risk doesn't really kick in until we get to that skip strike, which in this instance was the 1,835 strike. So the expected move is 100 points. And we are going from 1,700 to the spot where we really start to get concerned. From 1,700 up to 1,835 is 135 points in general. All right. Now, if we are dead wrong, and here's the biggest risk of this trade, the biggest risk is, let's say a gap's open and it gaps open 160 points. Now that's feasible in a stock like Amazon. It could possibly happen, and probabilities are low. But if that was the case and we didn't have a chance to trade out of it, we would lose $15, which is the width of that credit spread that's helped paying for the butterfly. So $15 times 100, because it's for every 1 by 2 by 1 that we do, for every one skip strike butterfly, is $1,500. So for every one that you put on, you need to have the margin, you need to be able to have the risk to be able to handle a $1,500 loss if the worst case scenario were to happen. But once again, you have many different scenarios that work out in your favor in this trade. If the market just opens up flat, the options are more than likely going to expire worthless, and you're going to receive that 80-cent net credit in your account for your efforts. The second scenario, besides the three scenarios, right? Either the market goes the wrong direction, we make 80 cents, or the market skyrockets up 160 points and we lose our 15 points, right? Our short credit spread, minus the net debit or net credit received, obviously. So it's really $1,500 minus $80. Our total risk, to be more accurate, is $1,420. The best scenario would be that Amazon actually would open up approximately, let's say, 50 points, about half of the expected move, and then it would start slowly moving towards our short strike, which gives us an opportunity to trade out of this position. So the ideal scenario would be right at expiration, Amazon closed right at our short strike, which is 1,820. If that happened, well, then instead of losing the 15 points, we would make the 15 points, the width of the spread. And then we would make that plus the 80 cents that we receive for putting on the trade. So it'd be $1,580. Now, obviously, the odds of that scenario happening is extremely low, that it would close right on that strike. And we really need it to close there because we need all the time premium to come out of our short options. We need time decay to happen. We need volatility to crunch and come in. But a more likely scenario that could happen is that it landed somewhere in between. If closer to expiration, it landed between our long first strike, which is the 1,805 strike call, and between that strike and the short strike, which is the 1,820 point call. So you got a 15-point range that we're going to call the sweet spot on this trade. And the best scenario would be that it opened up a good chunk of it and then slowly traded that way, because then it gives you that opportunity to trade out of it. And these type of trades, you're not necessarily looking to make a home run on them, but you got to manage your risk. If you can put this on for an 80-cent credit, and it's one of the weird trades where you can actually go and close it and receive a bigger credit. So I could put it on for an 80-cent credit and then close it out for $1 credit, making $1.80 on the trade. That's very feasible. They are capital intensive though, but you have three different scenarios that you can make money on in this scenario, in this trade. If the market goes down, you can make the net credit received. The market kind of goes up, you can make the net credit received. And if the market really goes up and goes up to your short strike, you can even make more than that. So you have three good scenarios. Your only scenario is a huge gap opening after earnings that would put you beyond the 1835 strike, or basically the strike that you're skipping in the normal butterfly. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.